As the Fed pivots toward easing, Singapore REITs are rallying. But is now the right time for Singaporeans to invest? Or are there hidden risks beneath the surface? Recent performance snapshot. Singapore REITs, S-REITs, have staged an impressive comeback following the Federal Reserve's recent rate cut announcement. The iEdge S-REIT index has gained nearly 5% over the past 2 weeks, significantly outperforming both the broader Straits Times Index, STI, which rose just 0.9%, and the global REIT benchmark, FTSE EPRA Nareit Global REITs Index, which actually declined by 3.4%. Leading the charge are the larger market cap S-REITs, with the 7 S-REITs in the STI averaging 5.6% gains in the same period. Particularly notable performers include Frasers Hospitality Trust, Frasers Logistics and Commercial Trust, CDL Hospitality Trusts, Parkway Life REIT, and Frasers Centrepoint Trust, which have collectively averaged an impressive 9.3% price increase. Looking at longer time frames, certain REITs have delivered even more substantial returns. Manulife US REIT and Keppel Pacific Oak US REIT have shown remarkable one-month total returns of 35% and 25% respectively. Other notable performers include Keppel DC REIT, 14.6% year-to-date, Capitaland China Trust, 17% over 1 month, and Mapletree Pan Asia Commercial Trust, 15% in 1 month. The iEdge S-REIT index generated a total return of plus 110% in just the first 8 weeks of the second half of 2024, signaling growing investor confidence in the sector. This performance surge has coincided with a reversal in institutional investment trends, with S-REITs recording net institutional inflows of about $42 million over the past 2 weeks after a period of consistent outflows. Drivers behind the rally. This resurgence comes after a challenging period for S-REITs due to elevated interest rates. Several key factors are fueling the current rally. 1. Lower financing costs. The Fed's pivot toward rate cuts is a significant catalyst, as it promises to reduce borrowing costs for REITs. With approximately 40% of S-REIT debt coming up for refinancing in 2025-2026, lower rates could substantially boost distribution per unit, DPU growth after a median decline of 8% in 2023. 2. Attractive valuations. S-REITs are currently trading at compelling valuations, with an average distribution yield of nearly 7% and a price-to-book ratio below 0.8 times, 20% below historical averages. Some S-REITs are trading at discounts of up to 33% below their recent peaks, creating potential for significant capital appreciation as the market recovers. 3. Economic resilience. Singapore's robust economic performance supports rental growth and momentum in the REIT sector. The city-state's continued status as a regional business hub has helped maintain occupancy rates across various property segments, providing a solid foundation for rental income. 4. Sector evolution. S-REITs are increasingly incorporating technological innovations and ESG considerations into their operations. Data centers are leveraging AI and cloud computing, warehouses are adopting automation and robotics, and retail REITs are collaborating with tenants on omni-channel strategies. Green-certified office spaces are commanding rental premiums, reflecting the growing importance of sustainability in the real estate market. Opportunities for investors. The S-REIT market presents several distinct opportunities for investors looking to capitalize on the current momentum. 1. Sector preferences: industrial, logistics, and data center. REITs stand out due to structural tailwinds such as e-commerce growth and increasing digitalization demand. Keppel DC REIT, for example, has shown strong long-term performance with an annualized return of 12.28% since 2014. The demand for data storage and processing facilities continues to grow with the expansion of cloud computing and AI applications. 2. Global diversification. Over 90% of S-REITs now own properties outside Singapore, offering investors exposure to international real estate markets through a familiar regulated investment vehicle. This geographic diversification can provide both growth opportunities and risk mitigation. S-REITs have expanded their reach to markets across Asia, Europe, Australia, and the United States, allowing investors to gain global real estate exposure through the Singapore Exchange. 3. Value investing potential. With many S-REITs trading at discounts to their net asset values, there's potential for capital appreciation through mergers, acquisitions, and privatization activities. Analysts have identified Paragon REIT and Suntec REIT as potential targets for such corporate actions. The current discounted valuations make S-REITs attractive targets for private equity and institutional investors seeking to acquire quality assets at below-market prices. 4. Recovery plays. Hospitality and retail. REITs are showing signs of recovery as tourism rebounds and consumer spending increases. CDL Hospitality Trusts and Frasers. Hospitality Trust have been among the top performers in recent weeks, reflecting improving fundamentals in the hospitality sector. The reopening of international borders and resumption of business travel have provided a boost to occupancy rates and revenue per available room. What could go wrong? Despite the positive outlook, several risks could derail the S-REIT recovery. 1. Rate cut uncertainties. If the Federal Reserve doesn't cut rates as aggressively as expected, or if Singapore's local interest rates lag behind U.S. rate cuts, the full benefits for S-REITs may be delayed or diminished. The Fed's decisions remain data-dependent, and market expectations have fluctuated based on inflation readings and economic indicators. 2. Refinancing challenges. While lower rates benefit new borrowing, only about 40% of S-REIT debt will immediately benefit from 2025 rate cuts. The remainder may continue to face pressure from prior rate hikes, potentially constraining distribution growth. REITs with high debt levels and near-term refinancing needs could face pressure if interest rates remain elevated longer than anticipated. 3. Liquidity and competitive risks. If rates remain elevated longer than anticipated, investor capital may continue flowing to safer assets like treasury bills and fixed deposits, which currently offer competitive risk-free returns of around 4%. This could limit price recovery and maintain valuation discounts for S-REITs. 4. Sector-specific vulnerabilities. While industrial and logistics REITs appear well-positioned, office REITs face ongoing challenges from hybrid work arrangements, and retail REITs must continue adapting to changing consumer behaviors accelerated by the pandemic. Office vacancy rates and rental reversion trends warrant close monitoring, particularly in central business districts. 5. Macroeconomic and geopolitical headwinds. Policy shifts under the new U.S. administration could introduce regulatory risks or delay rate cuts. Global economic slowdowns linked to high rates may reduce tenant demand, pressuring rental income despite recent revenue growth. Geopolitical tensions could also impact global trade and investment flows, affecting S-REITs with international exposure. 6. Execution risks. As S-REITs pursue global expansion and technological integration, they face increased operational complexity and execution risks. Overseas acquisitions require understanding of local regulations, market dynamics, and cultural factors, which can present challenges for REIT managers. Investment strategies. For investors considering S-REITs in the current environment, several approaches merit consideration. 1. Selective investing. Focus on REITs with strong fundamentals, including high occupancy rates, healthy balance sheets, and demonstrated ability to weather interest rate volatility. REITs with a lower percentage of borrowings hedged at fixed rates may benefit more from rate cuts. Key metrics to evaluate include gearing ratio, preferably below 40%, interest coverage ratio, ideally above 3x, and weighted average lease expiry, WAL. 2. Diversified approach. Consider investing in diversified S-REITs that offer portfolio resilience across different property types and geographies, providing stable operating performance amidst market uncertainties. REITs with exposure to multiple sectors can better withstand property-specific or regional downturns. 3. Dollar cost averaging. Rather than making a large one-time investment, consider phasing into S-REITs through regular investments over time. This approach can help mitigate the impact of market volatility and reduce the risk of poor market timing. 4. Sector rotation. Different REIT sectors may outperform at various stages of the economic cycle. Currently, industrial and logistics REITs offer stability, while hospitality and retail REITs present recovery potential. Investors might consider allocating across these sectors based on their risk tolerance and economic outlook. 5. Income focus. With S-REITs offering an average distribution yield of nearly 7%, income-focused investors can benefit from regular cash flows, even if capital appreciation takes longer to materialize. Reinvesting distributions through dividend reinvestment plans, DRIPs, can compound returns over time. Are S-REITs the right investment for you? The suitability of S-REITs depends on individual investment goals, time horizon, and risk tolerance. For income-focused investors, S-REITs offer attractive distribution yields in a low-interest rate environment. Retirees or those seeking regular income can benefit from the quarterly or semi-annual distributions, which are typically more stable than equity dividends. For growth-oriented investors, S-REITs with expansion plans, asset enhancement initiatives, and exposure to high-growth sectors like data centers and logistics can provide capital appreciation potential alongside income. For diversification seekers, real estate has historically shown low correlation with other asset classes, making S-REITs a useful portfolio diversification tool. The current sector-wide discount to book value provides a potential valuation cushion. Time horizon considerations. S-REITs are better suited for medium to long-term investment horizons, 3+ years, allowing investors to ride out short-term volatility and benefit from compounding distributions. Emerging trends. Shaping the S-REIT market. Several emerging trends are influencing the future direction of S-REITs. 1. Technology integration, data center. REITs are benefiting from AI and cloud computing demand, while industrial REITs are incorporating automation and robotics to enhance operational efficiency. 2. ESG focus. S-REITs are increasingly adopting environmental, social, and governance practices, with green-certified buildings commanding premium rents and attracting quality tenants. 3. Retail evolution. Retail REITs are reimagining spaces as lifestyle destinations and implementing omni-channel strategies to remain relevant in the e-commerce era. 4. Healthcare expansion. Healthcare REITs focusing on medical facilities, nursing homes, and wellness centers are emerging as resilient income generators with aging population tailwinds. Conclusion. The S-REIT sector presents an intriguing opportunity as it responds positively to the changing interest rate environment. The combination of recent strong performance, attractive valuations, and improving fundamentals suggests potential for both income and capital appreciation. However, investors should remain mindful of the risks, including the pace and extent of rate cuts, refinancing challenges, and sector-specific headwinds. For Singaporean investors, S-REITs offer a regulated, liquid means of gaining exposure to real estate across various sectors and geographies. With average gearing ratios of 38.7%, well below the regulatory limit, the sector demonstrates financial stability despite recent interest rate pressures. The current juncture may represent an opportune entry point for long-term investors, particularly given the significant discounts to historical valuations. However, success will likely depend on careful REIT selection rather than broad sector exposure, with emphasis on quality assets, strong balance sheets, and experienced management teams. While the Fed's rate cut trajectory has sparked the current rally, sustained performance will ultimately depend on fundamental factors such as rental growth, occupancy rates, and distribution sustainability. By aligning investment choices with these fundamentals, investors can position themselves to benefit from the S-REIT sector's recovery while managing the inherent risks of real estate investment.